Very good morning, friends. So I hope you're all doing well. And most importantly, I keep saying that I hope you made your cumulative revision, especially on the practical aspect of the consolidation technique. So we did a couple of questions last time as well, applying the 7-step model on consolidation. And we have come quite a way, where I've also given you some complications in terms of adjustments as well as the extract balance sheet. To be very precise in terms of the thought, I've given you a total of 3-4 adjustments, and I've also given you 3 areas where an extract balance sheet could be prepared. So I gave you the inputs in terms of number 1, that if there is, let's say, an adjustment related to intercompany owings, how would you tackle that? We understood number 2, if there is any unrealized profits, what we commonly call stock reserve, how do you tackle that up and downstream in nature? Number 3, we saw the concept of fair value adjustments, how the fair value adjustments are taken care. And number 4, I also gave you the impact of goodwill impairment. Which steps does it make a difference? So these 4 adjustments should be at the back of your mind. That is intercompany owings, unrealized profits, fair value adjustments, and the goodwill impairment. And you need to be very clear which particular step is going to get impacted on the 7-step model. Then I started my focus on the extract balance sheet as well. And I said that if there is any kind of omissions which are there, before you start the 7-step model, you need to consider an extract balance sheet. And I told you in January 21 examinations, the examiner tested the concept of an extract balance sheet. And the extract balance sheet means not only that it will impact the entry on acquisition date, but it can have implications up to the balance sheet date as well. Like, for example, we saw number 1, the concept of a DC, which will lead to unwinding of discount up to the balance sheet date. So when you make the extract balance sheet, you need to first of all put entries and then proceed. There could be number 2, a contingent consideration omitted from the books of accounts, which depends upon whether it is classified as equity or financial liability. And accordingly, the updation of the fair values would take place. So if there is DC, there is unwinding, and if there is CC, there could be a fair value changes if it is a financial liability. And I also give you there could be omissions in terms of issue of shares, etc. And you need to put the entries, but there are no changes if there is omission in terms of allotment of equity shares are concerned. So now when you read a question, because I'm now going to take you to the January 21 examination question early in the morning. That was a warm-up exercise of just reminding you the inputs. Your mind should be clear on these 7 agendas for the 7-step. I made 7 agendas for the 7-step model. So 7 adjustments, the 4 adjustments and the 3 extract balance sheet inputs makes it 7. And we got the 7-step model. I would say more or less in a comprehensive questions, these are the inputs you're going to confront. Though the extract balance sheet could also be hitting on account of other factors also. I'm not giving you the list of all those factors. There could be umpteen number of examples which could impact the extract balance sheet. Now, with this particular mind, in terms of the 4 adjustments, 3 inputs on extract balance sheet, let's now come to January 21 examination question. So let me, I think, share this question to you. I'll just zoom it across. Let me first put this in a size. So this is January 21 examination question, came for 15 marks in the exam. So let's first read the question and then we'll see if there is a need to make an extract balance sheet. We'll do that. And of course, if there is any other thing required, we'll see. Let's read. It says on 1st April 2017, A acquired, it says 80% share capital of S. So there is definitely NCI. Then he says on the acquisition date, the share capital and reserves stood at 5 lakhs and 125 respectively. I made a pinpoint on this last time as well, and I would like to, remind you again on this agenda. Many people get enamored with the fact that the examiner is also already telling you that what is the reserve and surplus on the acquisition date. But we know that when you do the analysis of other equity, it's not only based on the balance sheet analysis. It also contains fair value adjustments. It also contains the unrealized profits elimination, the three focus points, which means I need to do my analysis irrespective, even though the pre-acquisition position is already defined. Then he says A paid an initial cash consideration of 10 lakh, and I would just like to immediately take you to the balance sheet. Investment in S is appearing to the extent of 10 lakhs in the balance sheet, which means the investment is recorded at the initial payment. Additionally, A issued 2 lakh equity shares with a face value of 1 rupee at a current market value 1.8. I think even if you don't read further, we can definitely say that there is an omission in terms of allotment of shares to the shareholders of B, because this investment is appearing only at the amount initially paid. Then he says it was also agreed that A would pay a further sum of 5 lakh after 3 years, and there are no ifs and buts attached, which means it is a deferred consideration, a DC. And I think even this is not yet incorporated in the balance sheet. Then he says A's cost of capital is 10%, that is for unwinding, and the discounting rates are given. The shares number 1 and the DC number 2 have not yet been recorded by A. So it's a case of omission in terms of allotment of shares and DC. Extract balance sheet. When you read this information, then the bell should ring. This omission means that I need to make an extract balance sheet. So don't make the extract balance sheet directly. Put down the entries which would have been done on the acquisition date, subsequent to the acquisition date, and then make the extract balance sheet. Because there has been a gap. The acquisition date is 1st April 17 and the balance sheet is given on March 19, which means 2 years later. And I hope you also remember that when it comes to a DC, you also need to take a call that this DC is a current or non-current in the balance sheet, or is it partly current and non-current. In this particular case, the DC was payable 3 years later, and therefore 2 years have already passed by. So on March 19, the DC is supposed to be current liability because it's payable within 1 year from March 19. The balance sheet is given. Then let's go to the additional information. On the date of acquisition, the fair values of S plant exceeded the book value by 2 lakh, and the remaining useful life is 5 years at this date. Fair value adjustments. The consolidated goodwill is impaired by 258. So I think for this, I need to know that, NCI is it PASNA or is it a fair value? Let's see. A values the NCI using a fair value method, which immediately tells me that it is a full goodwill. And if it is a full goodwill, the impairment is borne by the parent NCI. So goodwill impairment should start hitting your mind in terms of which steps is it going to hit. And then it says on the acquisition date, the fair value of NCI is stated. You're required to make a consolidated balance sheet on March 19. Notes to accounts is not required. Okay, that's perfect. To my mind, as of now, when you read this particular question, even though this was the first time when the concept of a DC was asked as a part of the larger question, I think you should be still comfortable in terms of this question. As I read the question, your mind should be working very clear that, okay, this adjustments is going to be taken in this step, and all those things should immediately flash to your mind. If it does, that's great. And if it doesn't, I think it's time to do some cumulative revisions. Okay, so I think with this inputs in hand, let's begin the things. So I am going to first start with my extract balance sheet. So this is the January 21 examination question. So as I said, we've already made a focus that in this particular case, there is a need to make an extract balance sheet. Many a times, people do not make an extract balance sheet, they proceed directly. They feel that we'll incorporate these items in the 7-step model itself. You can, but my advice would be it is better that since there is an omission, it is more appropriate you first make your extract balance sheet and then proceed. At least we have taken care of the DC and the allotment of shares. So we're going to work upon the extract balance sheet. So we're going to work upon the extract balance sheet to begin with. So we need the entries on 1st April 17. So 1st April 17, there has been an omission. So I need to put the entries on 1st April 17. So let's go back to the question and see the entries which we need to draft. It says A issued 2 lakh equity shares with a face value 1 at a current market value 1.8. So what we need to do in this particular case, the entry which should have been done is investment debit. We should have taken a debit to the investment. Now, 2 lakh shares are allotted at a fair value 1.8. So there is a face value 1 which goes to the equity share capital, and that excess 0.8 goes in the security premium. So we give a credit to the equity share capital and we give a credit to the security premium. And let's put the amounts of the entry as well. So this is going to be 2 lakh shares into 1.8. This will be 2 lakh shares into the face value 1. And the excess 0.8, this enters in the security premium. Now, as soon as you put this entry, your mind should also work, is there any other entries to be done 2 years later? Because we are making the balance sheet on March 19. The extract balance sheet is going to be prepared on 31st March 19. So when you're going to make a balance sheet on March 19, you also need to visualize that there is any subsequent accounting for the next 2 years or not. In this case, no. So this comes to 3.6 lakh and this is 2 lakh and this works out at 1.6 lakh is the premium with no other entries to be done for the remaining 2 years. That's right. Okay, then let's go back and let's have a look further on the second omission. It was also agreed that A would pay a further sum of 5 lakh after 3 years and the discounting is given. Now, in this particular case, we need to first capture the present value of the future payment on April 17, and then we need to unwind the discount for the next 2 years as well. So let's go back and see the entries for the DC as well. So this entry is also done on 1st April 17. So the entry which we need to pass is investment account gets a debit and the deferred consideration going to get a credit. And this is going to be with the present value of the future payment. So if I just come back on the question, 5 lakhs is paid 3 years later, so into 0.75. So can you give me what is 5 lakh into 0.75, the present value? I guess 3.75 lakhs is the amount of present value. So we put this entry with 3.75 lakh. Now, as we proceed with the next 2 years, we need to consider the unwinding of discounts. So let's do separate entries on March 18 and on March 19 for the unwinding. So we look at the entries on March 18. And the entry is going to be finance charge gets a debit, which of course will be adjusted in the retained earnings in the extract balance sheet. And the deferred consideration gets a credit. And this amount is going to be on 3.75 lakhs. We need to unwind this at the same rate. The unwinding is at the rate of 10%. So we take a 10% on this. That is 37,500 at the end of 1 year. Let's go further. So on March 19, same entry to be done, and that is finance charge gets a debit. The deferred consideration gets a credit. And now we need to be careful that when you're going to put the amount of this entry, it is going to be on the cumulative DC amount. So what is the cumulative DC? 375 plus 37,500. The total cumulative amount in this case, 4,12,500. And we take a 10% on this, that is 41,250. So this is the entries which are done for the omission part. And trust me, once you get into the habit of putting these extract balance sheets for the omissions, at least you know the pressure which is there on the 7-step model gets eased out. Otherwise, you'll keep tracking, what is to be taken in which part of the step. So it's better to keep the extract balance sheet clear. Right, friends? I guess so far so good. I am clear with the extract balance sheet. Let me now make the extract balance sheet as well, because just the entries is not going to be the end of the story. We need to show the impact of these items on the balance sheet front as well. So let's look at the balance sheet extract. This is on March 19, and the balance sheet, of course, is of the parent company. So let's take the amount, and I guess let's see the changes on the asset side, and we'll see the changes on the equity and the liability side as well. So let's make the changes on the equity and the liability side as well. Now, the best way to keep a track of the extract balance sheet is go back to the entries, keep making a tick that yes, this is done, this is done. Let's, I think, go back. So I guess first of all, what I need to consider is the investment. The investment is debited at 3.6 and the investment is debited by 3.75. So we need to increase the investment in the balance sheet, which was, I think, at 10 lakhs. Increase the investment 10 lakhs plus 360 plus 375, I guess it comes to 1735. So in the non-current assets, I will consider the investment in the subsidiary company. And this works out at 17,35,000. This stands incorporated in the extract balance sheet. Wonderful. Let's go back to the entries further. I guess now time to make changes to the equity share capital, increase it by 2, and we'll take care of the security premium later. Let's see what is the share capital. The share capital is appearing at 20 lakhs and we've increased it by another 2 lakhs. So my equity share capital is now become a total of 22 lakhs after incorporating the increase of 2 lakhs in the balance sheet. This is the best way to track your inputs. Look at the entry, keep making the changes so that nothing gets omitted. Then I guess let's look at the items. We've created a security premium of 1.6. Let's go back to the balance sheet. See if there is anything on the equity on security premium. Nothing. Fresh creation. So we take the security premium as a part of the other equity. So the security premium is coming 1,60,000 is the security premium. Let's go back. So investment done, share capital premiums done. Now comes DC. DC is 3.75 plus another 37,500 and plus another 41,250. So we take the impact of this. It is coming to 375 plus 37,500 plus 41,250. So the DC is 453,750. By the way, it's going to be a current liability because it's payable 1 year later. So this comes to 453,750 is the DC in the balance sheet of the company. Wow. Let's go back and see what is pending. I guess the first entry done, the second entry done. Now the only inputs to be taken is the finance charge in the next 2 years. And where do you take the hit of the finance charge? You need to change the retained earnings in the balance sheet. So let's go back to the retained earnings in the balance sheet. The retained earnings is appearing at 14 lakhs and you need to reduce this by the figure 37,500 and 41,250. So the retained earning changes to 1321. 1321,250. This is the retained earnings. Not out here. This is 31,250. So 13 lakhs 21. This is going to be 13,21,250. This is the retained earnings in the other equity as well. Right, friends, I think we are done with the entries in the extract balance sheet. Super. Now, once you present this to the examiner that this is the omission and this is the extract balance sheet, it gives the confidence, it gives the examiner the confidence that what a clarity is in terms of the movements which have been omitted in the books. Let's now go back to the question and see what is now taken. I guess we've taken care of the first para except for the position of reserves. So there was an additional issue of shares, there was a DC, and the omissions has been totally taken care. Now the only inputs to be seen is one is the fair value adjustments, one is the impairment of goodwill adjustments. There is no stock reserve, there is nothing else. And even the examiner would understand this, that he would not load the question with so many adjustments. If there is an extract balance sheet, somewhere he is compensated by considering only the fair value adjustments and the goodwill impairment. Now we are ready to start with our 7-step model at this stage. So once we're done with the extract balance sheet, now remember one more important inputs. As you proceed with the 7-step model, wherever you need information from the balance sheet, don't look at the balance sheet in the question. Remember the extract balance sheet. Like for example, when you go to consider the purchase consideration, now it's time that you are going to look at the extract balance sheet. Don't look at the original balance sheet for the purchase consideration. So every time you're going to look at any information in the 7-step model, extract balance sheet on the agenda. So let's begin with the first step. So we've got our step number 1, and which is getting acquisition date and the percentage. So we get the date of acquisition and we get the percentage. So in terms of date of acquisition, it was April 17. And what was the percentage, if you remember? %. That's great. So 80% is the percentage of. Now let's go to the step number 2. And as you go to the step number 2, your mind should work on the category of the question. Focus, focus, focus. So we know very clearly that this is a case of a balance sheet which is at a later date. So we are making a consolidated balance sheet at a later date. So do we need the step number 2A as well as B? Yes. I would need the analysis of other equity in this case, tick box, and I would also need the net assets on the date of acquisition at a fair value, tick box. Let's now concentrate on the step number 2A, where the focus is in terms of 3 focus points. The moment you go to the step number 2A, your mind should tune in terms of the focus points. So we look at the step number 2A, where we're looking at the analysis of other equity. Right now, I'm not concerned with the extract balance sheet because the changes in the other equity is for the parent company, not for the subsidiary. So focus right now is not on the extract balance sheet. So let's first make a formatting. So we'll take particulars, pre and post acquisition, and define this in dates as well. So this is pre-acquisition and this is post-acquisition. And we take a column for the particulars. And it is always a good practice to define the dates as well. So pre-acquisition is supposed to be pre-1st April 17. And anything from 1st April 17 till March 19 is post-acquisition. Now, we're going to focus on the focus point number 1. Let's go to the balance sheet in the question. Look at the subsidiaries other equity in the balance sheet. So let's see what is the other equity in the balance sheet of the subsidiary. So in this particular case, we are clearly given there is only a retained earnings which is appearing to the extent of 300. Let's also see that what is the position of the retained earnings on acquisition date. First para. On the acquisition date, the share capital is 5 lakh and the reserves is appearing at 125 in terms of thousand. That's it. We are not given any dividend information, nothing. So life is simple. So we will first concentrate on the subsidiaries company's balance sheet, and as we proceed with the retained earnings, make your time scale. Get into the habit that you're going to first make a time scale to get the information. So this is on 1st April 17 and this is March 19, a gap of 2 years. So acquisition date is April 17 and March 19. So you need to also appreciate it's a 2 years gap. So we are given the balance at the acquisition date was 125 and on the balance sheet date is supposed to be 3 lakh. So I'll take the complete figures. This is 125 and this is appearing at 3 lakhs and there is nothing else given. So 125 becomes pre and the change 175 is post. So let's split this. 125 becomes pre-acquisition and the balance 175 earned during the 2 years becomes post-acquisition in nature. Superb. So this is done. The balance sheet focus is done. Then we go to the next stage, fair value adjustments in the additional information. So let's go to the next agenda. That is the fair value adjustments, which we need to see in the additional information. Trust me, as you go on a step-by-step basis, you can do the question with the absolute cool mind because your focus is very clear what is to be done at each stage. So let's now consider what is given in terms of fair value adjustments in point number 1. It says on the acquisition date, the fair value of the plant exceeded the book value by 2 lakh and the remaining life of the plant is 5 years. So there is a fair value increase on account of plant, which is to the extent of 2 lakhs becomes pre. And as soon as you consider this, there is a need to consider an additional depreciation as well. Now be careful as you consider the additional depreciation. The remaining life of the asset is 5 years. So 2 lakh by 5, there is an annual depreciation of 40,000. But we need to consider the depreciation for a period of 2 years in the post-acquisition. So 2 lakhs divided by 5, you get a depreciation which is 40,000. So we need to consider depreciation for 2 years in this case. Just to show the workings, 2 lakhs spread over 5 years gives you 40,000 per annum. And we've got a depreciation for a period of 2 years that makes it 80,000. Okay, so this is done. The third focus is on the stock reserve, which is upstream, which of course is not given in the question. I guess we are done with the analysis of the other equity. So let's see what is the sum total of this. So this will give me the pre and the post acquisition figures. This is working out at 325 and this I guess works out at 95, right?
Yes, sir.
Wonderful indeed. Okay, great. So now we are done with the step number 2A. Now the focus is in terms of step number 2B. So let's go to the step number 2B now. So in terms of the step number 2B, we need to consider now the net assets at date of acquisition and of course at a fair value. And for this, a focus comes, we need equity share capital plus the pre-acquisition equity. Now, don't get sentimental, because when you look at the equity share capital, the huge tendency is there was increase in the equity share capital. That increase was for the parent company, not for the subsidiary company. So not that you're going to incorporate the extract balance sheet here. So this is equity share capital plus the other equity, which is pre-acquisition in nature. So let's see what is the equity share capital of the subsidiary on the date of acquisition. Also, it was 5 lakh and it is still 5 lakhs in the balance sheet. So the equity share capital is 5 lakhs, and the other equity we have just seen in the analysis, that is 325. So this gives me a total of 825 is the purchase net assets on acquisition date. Done. My step number 2B is also taken care. Now we can go on to the step number 3, that is PC. You tell me now, friends, where do I look for the PC? What is the focus point as you look at the purchase consideration? That's right, extract balance sheet is what we need to see at this stage. So what was the figure in the extract balance sheet? Let's see. It was, I think, 1735. That is the extract balance sheet. And you know what people generally do when they do not make the extract balance sheet, what they'll end up doing, they consider all those adjustments which I've done in the extract balance sheets in this particular step. I would suggest no, it's better to make the extract balance sheet and make your life simple. Then we go on to the step number 4. And in terms of the step number 4, we are required to calculate the NCI, and we clearly know the NCI is at a fair value, which means the goodwill is supposed to be full, and we know the further implications as well. As soon as what comes to the mind is on the goodwill, we know that now impairment will take a hit on the NCI, impairment will take a hit on the goodwill calculations, and impairment will also take the hit on step number 6. So step number 4, 5, 6 will be impacted. And your mind should be clear. Step number 4 for the NCI share, step number 5 for the entire goodwill impairment, and step number 6 for the parent share, because this is full goodwill. So let's calculate the amount of NCI. So we need the NCI at date of acquisition. That is already stated in the question. So point number 3, it says that the NCI on date of acquisition is 3 lakh 80. So this is the NCI on date of acquisition. And to this we add the share in post-acquisition profits. So we add the share in the post-acquisition profits. And for this, you need to go to the analysis step number 2A and see what is the post-acquisition figure. That comes to 95,000, and out of this 95,000, 20% belongs to the NCI.
19,000.
That's 19,000. Great. So this comes to 3,99,000. And least we forget, we need to consider the impairment of goodwill, because the goodwill is supposed to be at a full value. So NCI will also bear his own share as well. So I think for the goodwill also the impairment figure is given. Sometimes the examiner could be in a good mood. He could also merge the inputs of Index 36, give you the data so that you can apply Index 36, get the carrying amount of CGU at the goodwill, compare it to the recoverable amount, get the impairment loss. So it doesn't give you the impairment figure. You do the impairment calculations as well. This time, point number 2, the goodwill is 258 already given. So out of this 258, 20% belongs to the NCI.
51,600.
51,600, that's great. Now let's see what is the NCI.
347,400.
347,400 is the NCI. Wonderful. Okay, so that takes care of my step number 4 as well. That is the calculation of the NCI. Now we go to the step number 5, which is goodwill. So let's go to the step number 5. And we need to again consider the goodwill impairment here as well. So I'm not even writing bargain purchase gain because I know there is goodwill impairment. So I know we're going to get goodwill only. So let's consider the purchase consideration. I think 1735. And to this we add the NCI. Am I safely going to take the NCI from the previous step considering that there is no dividends? Yes. But of course, we need the NCI on date of acquisition. That was, I think, 380, correct? So let's get the sum total of this. 21,15,000. And compare this with the net assets at date of acquisition. Step number 2B, what was the net assets?
8,25,000.
8,25,000. And we get the goodwill.
12 lakhs.
12,09,000. Great. And now the $1,000,000 question, which everybody most of the time I see go wrong. Are you going to reduce the goodwill 80% or 100% at this stage? What are you going to reduce in terms of impairment of goodwill? 100% or 80%, which is the parent company share?
100%.
That's right, 100%. That was 258. Because in step number 5, you'll always reduce the full impairment. Here, the idea is not the share. The idea is the new goodwill. So this, I guess, comes to
10,32,000.
10,30,000. Great. This is the goodwill which is going to come in the consolidated balance sheet. Wow. Now let's go to the step number 6. And when you go to the step number 6, you've got a couple of focus points. How many focus points in terms of step 6, by the way? So we go to the step number 6, which is making a consolidated balance sheet, other equity. And we've got a total of 4 focus points. That's very good. Because you've got number 1, post-acquisition share. Then there is goodwill impairment. Then there is stock reserve. And then there is dividends as well. You should also create your own mind map as well in terms of, after doing all the questions, put everything in a single consolidated mind map. Okay, so this is on the other equity. So I think now let's make a small little format. We're just going to make a small little SOKI practically where we're going to consider there is, I think, nothing in terms of tab number 3. I guess in this case, there is no other reserves. So we just got only a tab number 2. So I'm just going to put this as tab number 2. We've got a retained earnings and we've got a security premium. And tell me, where are you going to pick this information to begin with? You need holding company's own data. So where are you going to pick this? Extract balance sheet. Because you've already made the extract balance sheet, so it's time to pick the figures there. So can you tell me what was the holding company's own RE as well as security premium? So this is 13, 21, 250 and 160. So 13, 21. This is 13, 21, 250 and this is 160. You can give a reference to the examiner as well that this is picked up from the extract balance sheet which we have prepared. Okay, now let's get the focus points clear. Number 1, we are looking in terms of holding share in post-acquisition profits. So let's first consider the holding company share in the subsidiary post-acquisition profits. So what was there in step number 2A, post-acquisition?
95,000 was total post-acquisition profit and the
Wonderful.
share is 76,000.
Right, 80% makes it 76. Great. And then we need to consider the goodwill impairment as well. So minus the goodwill impairment. So when you go to consider the goodwill impairment, is it going to be full or 80%? This is parent share.
80%.
Correct. So we'll take 258 into 80% goodwill impairment.
2,06,400.
2,06,400. Okay. So this is two. Dividends is not there. Stock reserve adjustments are not there. So I think we are comfortably done with the step number 6 as well. Let's see the sum total of these figures.
11,90,850.
1190,850, and this is 160 only. Please better add these two figures also for the balance sheet. Maybe you can show them separately, but I'm just going to show it as other equity. So let's add this as well.
13,50,850.
13,50,850 is the total other equity in the balance sheet. Right, so now we can go on to the step number 7, which is making a consolidated balance sheet. But working notes are not required. No notes to accounts are required. So we'll do it in the same way as I gave you the formatting. So let's go to the step number 7. So let me just make the formatting for the balance sheet. Notes are not required, but we can still keep a track. So a column for the holding company, a column for the subsidiary, a column for adjustments, and get the total. So we make the consolidated balance sheet on March 19. So this is holding, subsidiary. You make the adjustments and get the total. Starting with the asset side, and let's take the non-current assets into account. Okay, let's now go back to the balance sheet. So I guess we're given the property, plant, equipment. So we need to consider the fair value adjustments and the additional depreciation as well. So I'll take the complete figures, 55 and 15 lakhs. So we consider the property, plant, equipment. This is 55 lakhs and this is 15 lakhs, right? Yes. And what was the fair value change? I think 2 lakhs. And what was the additional depreciation? I guess 80,000.
Yes, 120.
Yeah, that's net. So this is 70 plus 120. 71 lakh 20, is it? That's the net figure, 71 lakh 20. Correct. Okay, then let's see the next item in the balance sheet. Investments will not appear, but I guess we can take goodwill. So what was the goodwill post impairment?
10,32,000.
10,32,000 is the goodwill post impairment. Then let's consider the current assets as well. And in the current assets, we can take inventory, receivables, cash. I guess there is no stock reserve, there is no intercompany owing, so we can just comfortably add all these figures. So let's consider the inventory. If you remember the figures and trade receivables and cash, I think I've kept the question in front of me as well. Let me just give you the figures. Inventory is 5 lakh 50 and it is 1 lakh. So this comes to 6 lakh 50. Receivables is 4 lakhs and 2 lakhs. So this works out at 6 lakh. No intercompany owings, no stock reserve. Then the cash is 2 lakh and 50,000. So this works out at 2 lakh 50,000. I guess that's it on the asset side of the balance sheet. Let's see the total of the balance sheet now.
96,52,000.
96 lakh 52,000 is the total of the balance sheet. Wonderful. Now we are going to consider the equity side. So let's go to the equity side. Where are you going to pick up the share capital from? We need the parent company's share capital. So where are you going to pick this up from?
Extract balance.
Extract balance sheet. So let's pick the equity share capital from the extract balance sheet. So equity, we've got equity share capital. I guess that was 22 lakhs from the extract balance sheet. And then we can pick up the other equity, step number 6. So what was in step 6?
13 lakhs
1350, 850.
850.
Correct. Right. And anything else which I need to consider at this stage within the equity?
NCI.
CI.
Very good. So we need to consider the NCI as well. So what was my NCI? Step number
3
5.
3,47,400.
347,400 is the NCI. Great. Then I guess we can go back to the balance sheet. We need to see the extract balance sheet for DC as well. So for non-current liabilities, we can comfortably take 30 lakhs and 4 lakh. So non-current liabilities is 30 lakhs as well as 4 lakh. So that comes to 34 lakhs. And I guess we can now take the current liabilities. When you take the current liabilities, this will be taken including DC. We'll just merge the deferred consideration as well. So let's go to the balance sheet first. The current liability is 1250. How much was the DC? Extract balance sheet DC. And this is 6.5 lakhs. So we need DC from the extract balance sheet.
453 750 DC.
453,750. Great. Now we can get the total of the current liabilities. 1250, 650, 453, 750. I think it's 2353, 750.
750.
Great. So see, is the balance sheet agreed or not? If it does, that means we've done it absolutely correct. Talid, wonderful indeed. So this is 9652 is the total of the balance sheet as well. Wow, I think it took us almost around 50 minutes time to do this question. Cut a little revision, 45 minutes, not bad. For an examination question with presentation, I did with explanations, but trust me, if you do it in the exam, you'll do it almost around 30 to 35 minutes, depending upon your pace. Wonderful. So that was a little comprehensive question in terms of the consolidated balance sheet. Now, you asked me to take some questions where it also contains a stock reserve as well. So I guess I am carrying some questions which is containing the stock reserves as well. But I think I want to first do chain holding. So maybe you can do that question later, but I want to first do a chain holding. We're still on a consolidated balance sheet, and I am now going to take you to a specialized consolidation when there is a chain holding. So there have been 2 examination questions which have come on this area, and I'm going to take you on the examination question itself. So I'm carrying both the questions with me because after doing one question, you might feel that I want to do another question as well, because this is a little tricky area. So this was November 18, and then there was another question, July 21, which also came in the exams later. Okay, so let's, I think, begin with the question, which is the first question which came in chain holding in the exams. So this is question number 8 in front of you, which is on a chain holding. And I don't think so I need to really tell you that what is a chain holding, because we've already seen that at the time of scope as well. This was November 18. This was like the second attempt of the new course. May 18 was the first attempt where, you saw last time a simple question coming in, and immediately in the next attempt in November 18, a question came on a chain holding. So let's, I think, read the question first with you, and then I'm going to give you the steps would remain the same. The steps would remain the same. The only thing is that when there is a chain holding, you basically get two subsidies, so you'll have to do everything, twice. You get your acquisition dates and percentage twice. You do two analysis. You get two NCIs and two goodwills. Everything is two. So it's only increases the calculations with us. Let's now begin. It says prepare the consolidated balance sheet on March 18, 31st March 18 for a group of companies, Usha, Nisha, and Sandhya, and we are given the balance sheet. So as of now, I'm not concerned with the balance sheet. Then he says the following additional information is available. Usha has got 80% shares in Nisha, and Nisha has got 75% shares in Sandhya. The holdings were all acquired on 30th September 17. So all the acquisition, Usha and Nisha, Nisha and Sandhya, are on the same date. The business activities of all the companies are not seasonal in nature, and therefore you can easily assume the profits are evenly earned throughout the year. I think that goes without saying. Even if the question is silent, we presume that. Then he says on 1st April 17, that's the beginning of the year in which acquisition took place, the balances in the books of Nisha Sandhya for reserves and retained earnings are given. Help me in the analysis of other equity. Then he says 5 lakh included in the inventory figure of Nisha is inventory which is purchased from Sandhya. So we are given that there is inventory in the books of Nisha which is purchased from Sandhya. Is it up or is it down? Sandhya is selling to Nisha, so undoubtedly it is upstream in nature. So are you going to consider this in the step number 2A? Yes. Because if it is upstream, we'll take the impact in step number 2A. The parent company adopted a policy to measure the NCI at a fair value, applying Ind AS 103, that's the choice as per 103. Assume the market price of Nisha Sandhya is same as the respective face value. So whatever is the face value in the balance sheet, that itself is taken as the market price. The capital accounts to be adjusted, I think point number 6 can be technically ignored, because this was, using a term cost of control, which is more used in the, AS21 regime. So I think let's cut down the point number 6. Analysis of profits and notes to accounts must be a part of your answer. You can notice something very interesting, that apart from the stock reserve, there are no adjustments given. I am not given any fair value adjustments. There is no goodwill impairments. The only input given is the stock reserve. That's it. Because it was the first time a question on a chain came in, so it was simple. Let's now solve this question number 8. This was November 18 examination question. So let me add out here. So November 18 examination question, chain holding. Now watch the calculations very carefully, because at the start of the question, you will not see any differences at all. But there will be one particular typical adjustments which comes in terms of chain holding, where we need to understand what is to be done, and we also need to understand what is the logic of that adjustment as well. So otherwise, as I start with the question, you're going to see things absolutely smooth. Just remember, you need to double everything out here. So when you do the step number 1, there are 2 subsidies, etc. So first, let's organize the data. Let's go to the step number 1. So in terms of the step number 1, let's organize both the acquisitions. So we have got date of acquisition and we've got a percentage as well. So we need to see the stakes which are there, Usha in Nisha, Nisha in Sandhya. Usha's got 80% shares and Then Nisha has got 75% shares on 30th September 17. So date of acquisition is 30th September 17. This is Usha in Nisha and Nisha in Sandhya, same date. 30th September 17. This is 80% and this is 75%. I hope I got the figures correct, right? The percentages and the acquisition dates are correct. Just vouch me for that. Right? I got this correct? Now,
Yes.
we'll just like to organize something more. I would say, in terms of the chain holding, don't stop at this stage, unlike you stop in step one. Do something more because we'll need analysis further. So now a new additions, every time a new additions is going to come in my 7-step model in terms of chain holding, I'll keep pinpointing. So there is something more which you need to do at this particular stage. Let's organize the data. There is company Usha, there is a company Nisha, and there is a company Sandhya. So let's organize this percentage in a chain as well. We'll need that. So Usha has got 80% stake in Nisha. Nisha has got 75% stake in Sandhya. Now, watch this carefully as I give you the analysis. One thing is very clear that Sandhya is also a subsidiary of Usha. We all know this very well, that if A controls B and B controls C, A also controls C. So in this case, we can say Usha has got a control over Sandhya. But I need to see what is the percentage Usha has got in Sandhya. Usha has got 80% of 75%. So we will calculate what we call the effective percentage. What Usha has got in terms of Sandhya. So the
60%.
additional workings which you need to do in terms of step number one is the effective percentage. So how much did you give me beta? 80% of 75?
60%.
60%. So the effective percentage is 60%, which means the NCI is supposed to be 40%. Now you would ask me, why did you do this? I'll tell you why. At the end of the day, the consolidation is being done from the top company's point of view. If he is doing a consolidation, then everything will be seen from his perspective. What is the stake he's got in Nisha? What is the stake he's got in Sandhya? You need to see everything from the top company's point of view because now he has got two subsidiaries. The subsidy, which is the middle company, is a flat 80. But the company, which is the bottom company, the bottommost company, is supposed to be indirectly calculated. So we will do the consolidation from Usha point of view. So 80%, 20% NCI, 60%, 40% NCI. I hope you got the picture correct. Okay, this is step number one. Now let's go to the step number 2A. So we need to organize something massive in terms of the step number 2A, because now I need the analysis of other equity for the middle and the bottom companies both. Two analysis, two NCI, two goodwill, everything too. So let's do one thing. Let's organize the analysis. We'll make two analyses. Let's first create a formatting and then we'll pick up the informations. So let's first organize the data for the analysis. So this is particulars and let's get pre-post. This is particulars and let's get the pre-post. So this is my analysis of other equity for both the company. So we are taking the middle company is Nisha and the bottom company is Sandhya. And let's organize the data. This is pre and this is post. This is going to be pre 30th September 17 and everything from 30th September. What was the balance sheet date? March 18. So 30th September to March 18 is post. So very carefully define the pre and the post acquisition should be defined. See, effective percentage is for Usha and Sandhya, right? Yes, it is Usha and Sandhya. That's right, Usha and Sandhya. Okay, similarly, we define this as well, particulars. This is pre, and this is pre 30th September 17, and the post acquisition from 30th September till 31st March 18. So out of the current year, we can see 6 months is pre and 6 months is post. Your date of acquisition is middle of the year. So April to March, middle of the year, 30th September, acquisition date, current year, 6 months pre and 6 months post in nature. Now, your focus points would again remain the same. As you look at this analysis of equity, you need to see the balance sheet of the subsidiary, focus 1. The fair value adjustments not given in the question, focus 2. And there is upstream stock reserve which is given in one of the company. I think that was Nisha. I think if you look at the stock reserve, it was Nisha. We are given in point number 4 that 5 lakh included in Nisha. Yes, it was purchased from Sandhya. So in the analysis of Sandhya, you need to take care of the unrealized profits as well. Okay, so I guess let's begin the journey with the balance sheet of the subsidiary company. Let's focus on Nisha to begin with. So let's consider in this particular case, either you must be wondering, looking at the balance sheet, so why is the equity and the liability appearing in front? It should be, assets at the front. I mean, that's okay. The balance sheet in the question technically was not in accordance with the Schedule 2, Schedule 3, Division 2. That's okay. So let's, I think, look at the figures. So we are given reserves and RE. And this is the reserves and RE for Nisha, and this is the reserves and RE for Sandhya. So let's also look at the additional information. On 1st April, Nisha has got reserves of 40 and RE of 10 times scale. So we need to consider reserves and the retained earnings. So let's go with the reserves and let's see the time scale. So we are given 1st April, we are given 31st March, and in between is the date of acquisition, 30th September. I guess if you have the questions in front of you, you can just give me the figures again. I'll have to keep turning the figures here and there. I have the question in front of me, so I'll just give you the data. So if you look at the reserves of Nisha on 1st April, it was 40. These figures are all given in terms of lakhs. And if you look at the reserves in the balance sheet date, the reserves is appearing at 50. So can I say 40 is undoubtedly pre and the increase of 10? What do I do with the increase of 10? Can I divide it in the time ratio 1:1?
Yes.
Yes, 5 is pre and 5 is post, and please create a separate heading reserve. Last time I also said that when you do the analysis, get into the habit of segregating the post-acquisition columns. Reserves will be added to reserves. RE is going to be added to RE. So this is what we've done for the reserve. Let's go to the RE. Again, let's create the time scale as well. 1st April, 31st March, and 30th September, date of acquisition. I'm again looking back at the question data. The retained earnings is 10 at the beginning and it is 25 at the end. So 10 and 25. So we can comfortably take 10 as pre. There is no need to segregate any reserve RE in the pre column. And there is an increase of 15. Can I say time ratio 7.5? And this is 7.5 under a separate heading, retained earning. As simple as that. There is nothing new which we are doing in this analysis. This analysis has been done exactly in the same manner in which you do it even for a non-chain holding. Okay, my focus number 1 is done. Any fair value adjustments for Nisha? No. Any stock reserve for Nisha? No. I'm done. So let's consider the sum total of this. This analysis is done. This is 5 and this is 7.5. And I guess this is how much? 62.5?
Yes, sir.
Correct. The analysis of Nisha is done. Now let's go to the analysis of Sandhya. Same focus, we need to consider the balance sheet of the subsidiary company. And we need to consider, in this case, the reserve. Again, consider a time scale, 1st April, 31st March, and 30th September is the date of acquisition. Just organize the data. So if you look at the question, the figure of reserve on 1st April 30 and on the balance sheet date 40. So 30 as well as 40, we can again decide 30 is pre and the increase of 10 in the time ratio 5, and you create a separate heading, retained reserves and the retained earnings. So we're just taking the balance as pre at the beginning and whatever is the increase divided in the time ratio. Let's go to the next one. We are given the retained earnings. We make the same time scale, 1st April, 31st March, 30th September, date of acquisition. So we look at the retained earnings. At the beginning, it is 15. At the end is 30. So this is 15 and this is 30. So we get the figure 15 is pre and the increase of another 15 time ratio, that is 7.5, and this is 7.5. Wonderful. So far, so good. The analysis in terms of the balance sheet is done. Fair value adjustments are not there, but there is a stock reserve and that is upstream. So we need to eliminate that in the post-acquisition column. Let's go back to the question. Let's see the point number 4. It says 5 lakhs included in inventory of Nisha is inventory purchased from Sandhya at a cost plus 25%. So when it says cost plus 25%, you know this mathematically that it is 1/4 of cost and it is 1/5 on sale. Correct.
Yes.
When I say 1/5, that means 1 lakh, correct?
1 lakh.
5 lakhs. Wonderful. So let's create the stock reserve as well. Reduce it from the post-acquisition RE. This is 1. Just to show the calculations, this is 5 into 1/5 is the profit. So 1 lakh is the unrealized earning. No fair value adjustments. My analysis of equity done. So let's see what is the total of pre and the post figures. This is 5. This is 6.5. How much, beta?
57.5 pre.
57.5. Correct. Right. My step number 2A is done. And if you notice, I don't think so far we have done anything new in terms of step 2A. The step number 2A will not get impacted for chain holding. Step 1, the focus point is that effective percentage. Step number 2A, there is nothing different. Let's go ahead. Now let's go to the step number 2B, where we need to organize again the two informations on the net assets. So we need the net assets on date of acquisitions at a fair value and duplicate calculations all throughout. So let's organize two columns for the ease of convenience. We've got Nisha and we've got Sandhya, and we need the sum total of the equity share capital and we need the other equity that is pre, so that we can organize the sum total of this. Okay. Now, in this particular case, you need to go back to the balance sheet to see the share capital. And the share capital is appearing at 200 and 160. So this is 200 and this is 160. And what was the pre-acquisition equity step number 2A? 62.5, 57.5. This is 62.5. This is 57.5 from step number 2A. So this is 262.5 and this is 217.5, right? Correct. Right. So this gives me the step number 2B as well, organizing the net assets on the acquisition date. Now comes step number 3. So let's come to the step number 3 in this particular case, where we need the purchase consideration. So we'll organize this again in 2 columns to get the data clear. So this is going to be Nisha and Sandhya. So for this, we need to go back to the balance sheet to see the figures. So let's see what is the investment figure appearing here. Now watch this very carefully. I'm now about to add a new addition in terms of step number 4. Well, step number 3, sorry. When you're looking at the purchase consideration in a chain holding, there is something more to watch. Now, you can see the investments is appearing at 170 and it is appearing at 140. This is the investment Usha in Nisha and this is the investment Nisha in Sandhya. Now, the problem is that we are looking everything from Usha's point of view. If I'm looking everything from Usha's point of view, can I afford to take this investment at 140? No. So we need to consider that he has got basically 80% of 75. This 140 represents 75%. If this represents that 75%, I need to take 80% of this. Get my point very clear? When you're looking at a chain holding, I said at the very first step, you need to see everything from the top company's point of view. So we need to see the stake which Usha has got in terms of Sandhya. So this is the figure of investment which is Nisha in Sandhya. We don't need Nisha in Sandhya. We're taking from the point of view of Usha. So we don't need the investment which is Nisha in Sandhya, not middle 80% of this. That's 112. So this is another new thing which you need to do in terms of step number 3. Remember, the entire focus of consolidation is from the point of view of the top company. Since you're looking from the top company's point of view, the value of investment is from the middle company's perspective. I can't take that as a base. I need to see from the perspective of the top company. Since the top company has got an 80% share in, it's not that early, but I think I want to now ask you a small question now at this particular stage. Watch this. Usha has got shares in Nisha and Nisha has got shares in Sandhya. This is, can I say the money which with Nisha invested in Sandhya, hear me very carefully, this is a very crucial point. Can I say the money which Nisha invested in Sandhya is funded by the parent of Nisha and the NCI of Nisha? Am I right?
Yes, sir.
Wonderful. So can I say whatever money is invested by Nisha, that is 140. Out of this 140, 80% is financed, that is 112 by Usha. And can I say 20%, that is supposed to be 28, is funded by the NCI of Nisha. Correct?
Correct.
Perfect. So we need to keep this very clear in mind that this investment 80% financed by the parent company and 20% financed by the NCI. I'm going to use this information as I go to the NCI calculations as well. We'll come back to it. So this step number 3 is done. Now let's go to the step number 4. So now we go to the step number 4 where we are going to calculate the NCI. And let's do one thing. Let's do the calculations of the NCI and let's do the calculations of the goodwill simultaneously, because this is going to be something which are interrelated. So I'm organizing step number 4 and I'm also organizing my step number 5 as well, which is on the goodwill calculations. So let's organize the double inputs in terms of the two subsidiaries. Here also, let's organize the two inputs for both the subsidiary. So first, let's do one thing. Let's get the structure clear. Let's first of all organize all the data. Then we'll see the figures. Let's first get the the inputs. So let's take particulars. This is Nisha, and this is Sandhya. And I'm just going to first organize the particulars column before we go further. So the NCI, we need the NCI on date of acquisition, and we are given NCI in this particular case is supposed to be taken at a fair value. That's the policy of the company. Figures we'll take. Plus the share in post-acquisition. Plus we need to consider the share in the post-acquisition profits. And for this, we take the PC and add the NCI. And after adding the NC goodwill in this particular case. Okay, so let me just organize a bit of the part here also. Now watch this carefully as I proceed with the calculations. Now watch this carefully. I've just organized the inputs in the particulars. Now we need to see the figures very carefully. Okay, so first let's concentrate on the NCI on date of acquisition. So let's go back to the additional information. So I am given in terms of the NCI in point number 5, the parent adopted the policy to measure the NCI at a fair value and assume that the market price of Nisha Sandhya same as the respective face value. That means the face value of the equity share capital itself is the market price of the shares. So can I simply consider the share capital into the respective percentage of NCI? Yes, when I directly consider whatever is the share capital of these two companies, I can directly consider the NCI share. Now, when you consider the NCI, we need to consider the effective percentage in case of Sandhya, which is 40%. So in this case, 20% NCI, and in this case, 40% NCI. Let's go back, 200 and 160. So this is going to be 200 into 20%, that is 40. And this is going to be 160 into 40%, I guess that is 64. So one focus points, what you need to consider at this stage is the effective percentage of the NCI. That's what we did in step number 1. Because now the calculations for NCI is 40 and for goodwill is going to be 60. Let's now consider the share in the post-acquisition profits. Let's go back to the analysis. So in terms of Nisha, we've got post-acquisition reserve 5 and 7.5. So we can take the sum total 12.5 and take a 20% of this comes to, I've added the reserves and the RE put together. So 20% would be how much? 2.5. And similarly, we can go to Sandhya as well. If you go to Sandhya, Sandhya has got 5 and 6.5 in reserves and RE. That makes it 11.5. So out of this 11.5, 40% belongs to the NCI. Let's say 40%.
4.6.
That is 4.6. We are not closing the NCI at this stage. Let it be. There is something to be done further. Let's go back now on the PC. PC, we've already organized in step 3. This is 170 and this is 112. Now you can see something. This is based on effective 40% and this is also based on effective 60%, and we've not considered that 28 into account. What will we do with the 28 we'll see. Now as far as NCI on acquisition date is concerned, you can take the figures from top 40 and 64. So this is I think 210 and I think this is 176 I guess. And we need to compare this with the net assets on acquisition date. So this is on step number 2B, 262.5. And this is 217.5. So I think this time we're getting a capital reserve. So let's see what is the capital reserve. 52.5. And this is 41.5.
Yes, sir.
Let's also add the two capital reserve for the balance sheet point of view. I think it's 94. So this is coming to 94. Okay. Now comes the inputs to be done. What I'm going to do now, you will say, sir, what are you doing? And I will explain that in detail to you as well. Watch this now. What is the impact to be done? I took 80% of the investment here, and the remaining 20% is what is funded by the NCI, that is 28. So we are going to make a reduction of this 28 from Nisha's NCI. Did you understand the logic? You got the full right to say no. Say no. This is the adjustment for that 20% out here. So we can say we have taken 80% in this case, and we have taken 20% reduction from the NCI. Did you get the point? Nobody said a no. You said a no? Okay, great. I will explain that. No worry. Let me just close the calculations. Then I'll explain why the 20% got reduced from the NCI. Let's first get the figures. So this is, I think, 68.6. And this is 42.5 minus 28. I think it's 14.5. Let's add the two NCIs as well for the balance sheet point of view. 68.6 and 14.5. I think it's 83.1, correct? Okay, now I need to explain you why the 28 stands reduced before I go to step number 6. Now watch the logic carefully. If it clicks you in the next couple of minutes, and it should click. Let's now understand why did we do this. Let me do one thing. Let me consider the consolidated balance sheet out here. Now watch this carefully. It's just 2 seconds. It'll click to you. If it clicks in 2 seconds. You've got an investment which is Usha in Nisha, and you've got an investment which is Nisha in Sandhya. And let me get the figures as well. I think it was 170 if I rightly remember, and it was 140. So these are the two investments which are appearing in the balance sheet. Now, if you remember, when I started off with the consolidation technique, I made one sentence very clear, and I'd like to remind you of that sentence as well. I said the investment in the balance sheet is replaced by. I said the investment in the balance sheet is replaced by. I said number one, the net assets 100% irrespective of the percentage. And I said number two, it is replaced by goodwill. And number three, it is replaced by NCI. I'm just reminding you that the investment in the consolidated balance sheet is replaced by three elements. That is the net assets, 100%, goodwill, and the NCI. Now let's go one by one. Now, if you look at the status of Usha in Nisha, we eliminated this investments and we aggregated the net assets of Nisha, that is 100%. We aggregated the net assets of Nisha 100%, and we also computed the goodwill. We also computed the goodwill of Nisha, which was based on 80%. We also did the calculations of goodwill, which is based on 80%. And we also took the NCI in terms of Nisha that was based on a 20%. Agreed, then say a yes. Because this is a crucial point. Wonderful. So what I did, I eliminated the investment and took 100% net assets of Nisha, goodwill based on 80 and the NCI based on 20, a perfect elimination of the investment. Now let's come to Nisha in terms of Sandhya. Did I eliminate the investment? No. I did not eliminate the investment in this particular case. I eliminated the investment only to the extent of 112. The 28 investment was not eliminated. This was eliminated. This was not eliminated. When I did the calculations of the goodwill, I did not eliminate 140. I took only 80%. 28 investment is still lying out there. Did I incorporate the net assets of Sandhya that is to the extent of 100% in the balance sheet? Yes, I'll do. I will incorporate 100% irrespective of the NCI. When you took the goodwill in terms of Sandhya, in this particular case in goodwill, you considered only 60%, not the 80, 75%. You did not consider. You did not consider 75% in this case. You took only 60%. So goodwill was based on a 60%. So you can say that out of this, 80% of the goodwill calculations done. And even when you took the NCI of Sandhya, the NCI of Sandhya in this particular case is now taken on the basis of 40%. Now, we need to understand one small little thing. This 28 is still appearing in the consolidated balance sheet because what you did, you took only 60% here and therefore you took a 40% NCI. So the 28 is not eliminated. It is still appearing on the asset side of the consolidated balance sheet, mind you. Since your goodwill calculations are based on 70-80%, so this 28 is still appearing as an asset in the balance sheet. Now I need to see who does this 28 belong to. Out of this 140, we can say it was funded by, as I said earlier, this 140 is funded by the parent to the extent of 80%, and the remaining 20% is funded by the NCI. So this money, 28, is supposed to be funded by the NCI. That's what we said earlier. If it is funded by the NCI, that means on one hand, you're saying, I owe this NCI. And on the other hand, you're showing that this is the amount which is recoverable from the NCI. So which means this 28 is what belongs to the NCI. And this is the amount payable to the NCI. So what makes sense that we should, do a set off in this case. We should do a set off in this particular case. Because if I don't do this set off, what will happen? The 28 investment will continue to appear in the consolidated balance sheet. And I can't afford to show the 28 on the asset side of the balance sheet. So in order to eliminate the 20, we are setting it off. Sorry, I mind this is not setting off from here. Setting off from here, not in this case. We are doing the set off in this particular case. So this is the set off which we are doing, because this is the money which is owed to the NCI of Nisha, and this is the money invested by the NCI. So what we need to do, we need to do a setting off in this particular case. So that's the reason when we did the calculations out here, this 28, which is the investment which would otherwise would have continued in the consolidated balance sheet, gets eliminated. Did you get the logic? Got it? Wonderful indeed. So moral of the story, when you are going to do a chain holding, this is something which will confront every time in a chain holding, which means that your journey starts in terms of step number 3 itself. When you're going to do the step number 3 itself, in this particular case, you'll consider 80%, the effective percentage for goodwill. So when you're going to base your calculations of goodwill on that effective percentage, then the remaining which belongs to NCI will always get reduced from the NCI. So this is what you need to keep a track in. Okay, so this is done. My step number 4 is done. My step number 5 is also done. Now let's go to the step number 6. So now we go on to the next step, that is a step number 6. Here again, in terms of step 6, when you're going to make the consolidated balance sheet in terms of other equity, now we need to keep a track of the two companies. One is Nisha and one is Sandhya. So we need the tracking for both. Let's do one thing. Let's make a little comprehensive inputs for the two companies. Let's make two columns separately. So we'll take first of all, or rather, let's not do that. Let's, I think, consider the common formatting only. So let's consider there are, I think, other reserves was there. So in the balance sheet, reserves and RE is given. I presume the reserves is tab number 3. So let's consider the position of the tab number 2, which is RE, and let's consider the position, and there is capital reserve as well. And let's consider the tab number 3, which is reserve. I'm presuming that these reserves are the other comprehensive income, tab 3. So let's get the data. Now we need to get a lot of inputs, focus points, 4 focus points. In terms of dividends, nothing is given. Stock reserve, downstream is not there. Upstream is already taken. And we need to consider post-acquisitions, goodwill impairments not there. So the only thing to be seen is the post-acquisition shares. That's it. So let's see what is the holding company's own position. Let's go to the balance sheet of Usha, and it has got a retained earnings 80, and it has got reserves to the extent of 90. This is the own reserves and retained earnings in the balance sheet of the company. Now let's consider the share in terms of two things. The share of Usha in Nisha and the share of Usha in Sandhya. Everything is to be seen from Usha's point of view. So we need the post-acquisition share, Usha and Nisha, Usha and Sandhya. So let's see the post-acquisition share in the analysis step number 2A. Let's go back to the analysis in this case. So we need to consider in 5 and 7.5, and we need to consider in 5 and 6.5. So let's carefully pick this up. So what was the reserves, I guess? The reserves was to the extent of 5. The reserve was 5. And what was the retained earnings? I forgot the figures. What was RE? 7.5, 6.5? Reserve is 5, 7.5 and 6.5. That's right. So this is 7.5 and this is 6.5. So let's see the percentages in the post-acquisition shares as well. Now remember, the percentages will be the effective percentages. So in terms of Nisha, this is 80%. And in terms of Sandhya, 60. This is 80%. And this is 60%. Effective percentages to be taken. Let's see the figures. This is, I guess, 6. This is, I guess, 3.9. This is 4 and this is 3. And I guess we can take the capital reserve as well. What was my capital reserve in terms of the goodwill capital reserve calculations? I think I remember 94. What was the reserve? Capital reserve figures, that was how much? 94 is the capital reserve. So we take the capital reserve out here. This is 94 and this is going to be 97 and this is 86 plus 3.9, 89.9. Let me just add up all this for the balance sheet point of view as well. So this is 94, 89.9, 97 to 80.9. This is the other equity in the consolidated balance sheet as well. Okay, now we're going to make the consolidated balance sheet also. So let's make the consolidated balance sheet. I think I'm going to make the consolidated balance sheet in the same scale. So let's create a separate space, step number 7. So we're going to consider the step number 7 in this case. Let's make the consolidated balance sheet. Now you need to remember to consolidate all the 3 companies. We need to consolidate the parent company, that is Usha, the 2 subsidiaries Nisha and Sandhya, all 3. So let's create columns for consolidation. So we've got Usha, Nisha, Sandhya, adjustments and the total. So let's consider Usha, the middle company Nisha, then the bottom company Sandhya, and then the adjustments, and then let's get the total as well. Let's start with the asset side of the balance sheet in this case. So as we start the asset side, I guess let's begin with the asset side of the balance sheet. So we'll take the figures. I guess I have the question in front of me, so I'll just take the figures. I think the only inputs to be taken is the stock reserve. Other than that, I think there is nothing else given. So we can comfortably pick up the information from the question. So let me start with the NCA. And in terms of non-current assets, we've got tangible assets. I pick up the figures of Usha 160. Is it 490?
Yeah.
Correct. And then we've got investments which would not appear. And there was a capital reserve, so we're not concerned with that. Then we've got the current assets as well. The current assets, we've got the cash and the cash equivalents given at the first in the balance sheet, though it should be appearing below, that's fine. So this is 114,2020. No adjustments. So I guess it comes to 154. Next, we are given the bill receivable and the trade receivable. So bill receivable is 36 and it is 0 and 15. I guess there is no intercompany owings as well. No. So 36, nil and 15. So I think this is 51. Then there is a trade receivable 130.50, 130.50 as well as 110. No adjustments. 290, I guess. Then there is inventories. We've got a stock reserve to be eliminated as well. So inventories.
Bill receivable adjustment.
Sorry.
Bill receivable adjustment.
Is there any bill receivable intercompany owings?
Yes, sir. Bills payable.
Oh, yes. In the balance sheet, we are given bills payable that is owing to each other 35, 15, 50. So let me eliminate that 50 out here. So there is an intercompany owings of 50. So I think this is one. 490, 154, 290, 169. I think it's 1103. Right. Now let's go to the equity and the liability side as well. So on the equity liability, let's take the equity share capital of the parent company only. That's 300. So this appears at 300. Other equity, what we took was how much in step number 6?
Yes.
Oh, I did a mistake. 1104. Great. So this is 1104. And let's see what is the NCI. How much is the NCI? We took the total. I think that was
83.1.
83.1. That's 83.1. Correct. And then on the balance sheet, there are no non-current liabilities. We take the trade payable. Bills payable gets eliminated. So we take a trades payable on the current liability. That is, I guess, 235,115 and 90. No adjustments. Bills payables will get eliminated. For 40. So I guess hopefully they should close the balance sheet as well. See if the balance sheet is talent. Before we give you a break, so let's just have a little quick inputs on the chain holding, which steps needs your caution at this stage. Focus points on a chain holding. And you get your additional percentage, effective percentage clear. There is nothing special in terms of step number 2A or in terms of step number 2B. So nothing in terms of step 2. Step 3, you need to organize the effective cost as well. So step number 1, organize the effective percentage. Step number 3, organize the effective cost as well. This is going to impact your step number 4 and 5. And how does it impact your step number 4 and 5? I would say more like a contrast set of entry. When you consider the effective cost out here, the remaining money funded by the NCI is going to get reduced from the NCI. So step number 4 and 5 is going to be the set of impact which will come. Then in terms of step number 6, usual accounting, nothing different in terms of the step number 6 as well, absolutely the normal accounting, and nothing great in terms of step number 7 as well. So I would say the crucial point is step number 1, 3 and goodwill NCI. You organize the percentage effective in step 1, you organize the effective cost in step 3, and then step 4 and 5, you just need to eliminate the set of amount funded by the NCI. That's it. Otherwise, the normal sequence of 7 steps applies in this case. You want me, friends, to do another question on a chain holding which came in the exams as well? Because I think one question may not feel very comfortable. You want me to do another question as well? I get a yes on that. Okay, so we'll do another question also so that you get complete hang in terms of things. This time we'll take your inputs in terms of things as well. But first, I think time to give you a break. I'm sure you need one. We'll do another question on a chain holding after the break with you.
एक्सक्यूज मी सर।
Enjoy it. हाँ जी बेटा.
सर एक्चुअली बाकी कोई मुझे यानी डाउट नहीं है। बस एक चीज पूछना था कि जो हम अर्लियर क्वेश्चंस करते थे तो उसमें हम जो सीबीएस अदर इक्विटी है होल्डिंग कंपनी का, उसमें हम डिविडेंड माइनस करते हैं जितना उस होल्डिंग कंपनी का पार्ट है उतना, है
Correct.
ना? तो फिर हम एनसीआई में डिविडेंड माइनस क्यों नहीं करते जो कि एनसीआई का पार्ट होना चाहिए?
Dividends बेटा is already been paid off. आप dividends already pay कर चुके हो.
यस सर।
क्योंकि आप डिविडेंड्स ऑलरेडी पे कर चुके हो. तो जब आपने एक फोकस पॉइंट याद दिलाता हूं, जब आपने एनसीआई के लिए नेट एसेट्स की फिगर पिक की थी तो कौन सी फिगर पिक की थी? स्टिल अवेलेबल ऑन एक्विजिशन डेट या स्टिल अवेलेबल ऑन द बैलेंस शीट डेट?
बैलेंस शीट के लिए तो सर बैलेंस शीट डेट।
तो इसका मतलब उसमें से डिविडेंड माइनस हो चुका था.
यस सर।
तो इसका मतलब एनसीआई के शेयर में जो आपने अमाउंट दिया वो ऑलरेडी आफ्टर डिविडेंड सब्ट्रैक्शन था.
यस सर।
गॉट द पॉइंट?
यस सर, एक्चुअली मैं वही सोच रही थी, फिर भी यानी वो क्लियर नहीं हो रहा था, उसमें उलझ रही थी, इसीलिए थोड़ा आपसे
नहीं, दैट्स
क्लियर।
परफेक्ट. क्योंकि एक्चुअली दो में फर्क है ना, इसलिए मैंने उसका पॉइंट स्ट्रेस किया. जब आपने गुडविल कंसिडर की तो गुडविल के अंदर आपने नेट एसेट वो लिए जो एक्विजिशन डेट पे थे डिविडेंड से
यस
पहले.
सर। हाँ सर।
तो इसका मतलब पेरेंट के पॉइंट ऑफ व्यू से जो कैलकुलेशंस की वो आपने डिविडेंड से पहले वाली की, लेकिन एनसीआई में आपने नेट एसेट्स आफ्टर डिविडेंड वाली लिए, तो वो वहां से ऑटोमेटिकली एलिमिनेट हो गए. अब क्योंकि पेरेंट ने अपनी बैलेंस शीट में रिटेन अर्निंग्स क्रेडिट कर रखी है तो नेचुरली ग्रुप पॉइंट ऑफ व्यू से इनकम बनी नहीं, तो उधर से एलिमिनेट करना पड़ेगा.
ओके सर, थैंक यू सर।
You're welcome, beta. Right, so we'll take a 10-12 minutes break and I'll see you after the break. Relax your minds. We'll do another question of chain holding after the break. Enjoy your break. Friends, I guess you had a relaxation of mind. I guess I'm getting a question. So I have a doubt on something dealt few classes back. Can we look into it at the end of the session? Of course we can. Not a problem. You can ask your doubt at the end of the session. Okay, now let's, I think, do another question on a chain holding, which is also an examination question. And we're going to make the walkthrough of all these steps with you. So this was November 18. Then there is another question which came in the exams in July 21. So let's have a look at the examination question, July 21. It came for 16 marks in the exam. It says given is the balance sheet of the group of companies LX, MX, and NX on 31st March 21. So I guess I'm not looking at the balance sheet at the moment. It says LX has got 85% shares in MX, which is acquired on 1st April 2020, couple of years, 1 year back. And MX has got 80%, 60% shares, I think, in NX, which is acquired on 30th September 2020. So I think you must be wondering in terms of the previous question that, the acquisition dates were common. So at least we've got another agenda where there are two different dates when the top acquired in the middle and middle acquired in the bottom. The position on 1st April 2020 for both the reserves are a given. The business are not seasonal in nature, so we can take a time ratio to spread the earnings. The parent company adopted the accounting policy to measure the NCI at a fair value as per 103, and the fair value is taken on the basis of quoted market price. The market price this time is already given 120 and 125 per share. Unlike the previous question, we are required to make a consolidated balance sheet on March 21 for the entire group as a whole. Now, this time you can see that there is no adjustments as well. The question becomes even more easier if you ask me, because there are no fair value adjustments, there is no stock reserve calculations, nothing at all is given. And I guess we can start a journey. Let's, I think, begin the July 21 examination question. So let's see the July 21 examination question. So we're going to apply a 7-step model. And as we decided, we're going to focus on the special issues related to each and every step in this case. So in terms of step number 1, you need the date of acquisitions and the percentage. So for both the stakes, we need the percentage and we need the date of acquisition as well. And I think let's get the chain. I guess if you have the question in front of you, otherwise no problems. I'll keep showing in between as well. LX has got in MX. LX has got shares in MX and MX has got shares in NX. And I guess if you look at the percentages, we're clearly given that it has got a total of 85% stake, and this is a 60% stake, and the date of acquisition is supposed to be 1st April 2020, and this is supposed to be 30th September 2020. So this is the date of acquisition and the percentage. What is the special agenda to be done now in this particular case? You tell me.
LX holding in NX we have to take.
Very good. So we're going to create a change. LX has got shares in MX. MX has got shares in NX to get the effective percentage. This is 85% and this is 60%. I need what is the effective percentage.
51%.
We need what is the effective percentage LX in NX. How much is it, beta?
51.
Fifth going to be 49% in this case. Great. So my special agenda in terms of the step number 1 is done. Now we go to step number 2A, analysis of the other equity. So let's create 2 charts in terms of analysis of equity. We've got 2 subsidiaries, so 2 charts to be created. So column for particulars and then pre-post. Same goes for the other company as well, particulars and a pre-post. So this is my step number 2A. In terms of step number 2A, we need the analysis of other equity. So the company middle one is
Progress.
pre and post. Now this time, as you define the pre-post, the dates in both the companies are different. So we need to keep a track of that. MX, I think, was 1st April 2020, I guess. So this is pre-April, 1st April, and this is anything from 1st April till March 21. That is the post-acquisition. And this is, I guess, pre-30th September. And anything I would say from 1st October till 31st March 21 becomes post-acquisition. Right, now the three focus in minds, we need to look at the balance sheet of the subsidiary, no fair value adjustments, no stock reserve adjustments. So only the balance sheet will take care of things. So let's see the subsidiaries company balance sheet in this case. I'll just show you the balance sheet once, then I'll pick up the data. So in the balance sheet, we can see that there is other equity in terms of reserves and RE. So we need to do the analysis of reserves and the retained earnings. And you're also given in the additional information, the reserves and the retained earnings on the 1st of April 2020. So the balance on 1st April 20 for one of the company pre and for the other company also pre, but we need to be careful on the post period. So let's organize the data for MX. So let me make a time scale in terms of the first item, that is reserve. So let's take the time scale. This is 1st April and this is 31st March. In this case, 1st April is the acquisition date itself. So if you look at the balance of MX in terms of reserve, it is 760. And on 31st March, the balance of reserve is appearing at 810. So can you tell me what is pre and what is post?
Entire is pre 760.
Wonderful. And the balance 50 becomes post in nature. Separate column, reserve. Because in this case, acquisition date is 1st April. So the entire increase is post in nature. In this case, it will be time ratio. Let's go to the next item in the balance sheet, that is retained earnings. Again, make a time scale on 1st April and on 31st March. So if we look at the RE on the 1st April, it was 480. And if you look at the retained earnings at the end of the year, so that is given to us, I think it is appearing to the extent of 600. Now again, the same thing, 480 becomes pre and 120 post under a separate column, that is retained earnings. Just remember to segregate the columns in the post acquisition period. That's it. No fair value adjustments, no stock reserve, nothing. Let's take the sum total of this. So this is 50 and 120, and this will be
1240.
1240. Great. So this takes care of the analysis of MX. Now let's go to NX. Same, we look at the subsidiary company's balance sheet. Let's start with the reserve. Let's take the time scale, 1st April, 31st March, and in between 30th September is the date of acquisition. So unlike this company where everything was post, we need to divide in time ratio in this case. So if I look at the additional information, NX has got a reserve of 520 at the beginning. And the balance sheet reserve is appearing to the extent of 580. So tell me how much is pre and how much is post.
520 is free
Wonderful.
and 60 divided in the time ratio.
Very good. So
30.
60 divided 1:1 in the time ratio, 30/30. Excellent. So this is reserve, and then we consider the retained earnings as well. Now you can see, once you get the catch of the question, speed will also increase. So then we consider the retained earnings. Again, let's consider the time scale, 1st April and 31st March. 30th September is date of acquisition. This time scale, I always keep telling people, very important to keep a track. So in terms of the RE, it is 150 and the closing is 310. So 150 is pre, and what is the difference in time ratio?
80.
80. 160 divided 1:1, separate column, that is RE. And that's it. Nothing else is given. So we can comfortably take the sum total out here. This 80. Oh, what happened suddenly? The question is not digestible to my system. Okay, let's see the sum total of the pre-acquisition.
780.
780. Great. So this gives me the analysis of the equity. Step number 2A is done. Now we can go to the step number 2B, organize the net assets on acquisition date. So we come to the step number 2B, which is calculating the net assets on acquisition date of acquisition at a fair value. So let's organize the two columns in this case as well. So we need the inputs for MX and NX. So we need the sum total of the equity share capital and the other equity, which is pre-acquisition, to get the status of the net assets. Let's go to the share capital in the balance sheet of the company. So I guess the share capital is appearing at 2,000 and 1,600 respectively. So this is 2,000 and 1,600, and see the step number 2A.
1240
1240
and 780.
and 780. Great. So we can see what is the total of the net assets. This is 3240.
And 2380.
2380. So there was nothing special in terms of step 2A or B. It's absolutely done routinely. Now comes step 3, focus. Your purchase consideration has got some adjustments coming in. So let's go to the step number 3. And in terms of step number 3, we need the purchase consideration. And let's organize again for the two companies separately. So MX as well as NX. So what is the investments in the balance sheet of the company? So investment is appearing at 2620 and 1350. 2620 and this is 1350. So what do we do with this 1350 now?
In the ratio of the share NCI and parent company.
And what percentage are you going to pick, beta, in this case?
51 and 49.
51
Yeah,
and
but we
49.
need to take 85% of this, right?
Yes, sir.
Correct. So we'll take 85% of this figure, which will give you the effective stake of 51%. Let's see 85% of this.
1148.
1148. Okay, so step 3, inputs done. We've taken what is the stake of the top in the bottom company. He's got 85% in the middle. So we take 85% of that. So can I make a statement again that 15% is funded by the NCI, correct?
Yes.
Yes. Then let's go to the step number 4. And I think step number 5, we'll do it together. So let's first organize the step number 4 and 5. So I would always advise, first, since it is chain holding, let's organize the inputs to begin with and then proceed. So we've got NCI and we've got goodwill or bargain purchase gain. Let's organize the data. So we've got NCIs in the two company with adjustments. So let's first organize the data and then we'll put the figures also. So we're going to consider MX and NX. We're going to consider MX and NX. And this is particulars. So we need the NCI on date of acquisition. And to this we add the share in post acquisition. Anything else to be adjusted at this particular stage? Any further adjustments to the NCI?
Yes, sir.
And what would that be? Set off. We need a set off at this stage, right? So we need to create a set off at this stage. So let me also write down minus the set off at this particular stage so that everything is well organized. We remember and keep a track. 85% investment gone here and the remaining 15% will be a reduction from the NCI. Let's now get the data. So let's begin with the NCI on the date of acquisition. Let's go back to the question. It very clearly says that as far as the NCI is concerned, it's taken at a fair value and the fair value of NX is 120 and the fair value of NX is 125. So let's do one thing. Let's consider the number of shares. Out of this 2000 and out of this 1600, first let's take what is the number of shares. Number. So if it is 100 rupees per share, can I say this is 20 and 16? So this is coming to 20 and this is coming to 16. Can I say what is the percentage of the NCI in 20 shares? 20% was it?
15%.
MX sir,
No,
MX
for
में
the first
15%.
Okay, 15%, right. So 15% NCI and the market value was, I think, 120.
Yes, sir.
And this is how much? 49%, correct? And the market price is 129, 125. So we need to be careful on the calculations, very clear that this is supposed to be number of shares into the stake of NCI into the market price. Number of shares into the percentage of NCI into the market price. Let me just verify the prices again. Yes, 120 and 125. That gives me the NCI at a fair value.
360 MX.
360 and
This is
980.
360 and this is
980.
980. Okay, then we go on to the share in the post-acquisition profits. That would be in the analysis, step number 2B. And this is 50 and 120, 170, 30 and 80, that's 110. So 170 and 110. 170 and 110 into 15%, and this is into 49%. Post-acquisition share.
25.50, sir. First.
25.5. 53.9. Now tell me what is the reduction from the NCI of NX, the set of amount which you are going to reduce at this stage. Give me the figure. What is the amount which you're going to reduce as a set off in this case?
202.5.
Yes, that's right, 202, 15% of 1350. So this 202 gets reduced from here because here you're going to consider 1148. So 85% enters the goodwill and 15% net off from the NCI. Great. Let's go ahead so we can get the NCI in the meantime. 183.5. 1033.99. 1033.9, sorry. And I guess if I take the sum total, is it coming to 1217.4? Just
खराब
check
है
the calculations. Is it correct?
मंजुआ को फेंका लगी रही
25.5.
Correct, sir.
Great. So this is correct. Now let's come to the goodwill calculations. So PC is 2620. The other one we have already taken. NCI on the above 360 and 980, which is on the acquisition date. We're safe because there is no dividend. So I think we're comfortable to pick the informations. So this is going to be 2980. And this is 2128.
128.
Correct. And we got the net assets 3240 and 2380. So both the cases we are getting a capital reserve. 260,
252.
252. We can add the two for the balance sheet perspective. 512. I think the major complications are taken care. Once you get the hang, it's very, very easy. You just need to know that chain holding, I need to consider effective percentages, the PC effectively taken, and the set of entry to be taken. Rest is simple. Okay, now let's go further to the step number 6 as well, consolidated balance sheet. So let's now go on to the step number 6. So in terms of the step number 6, we'll organize the consolidated balance sheet, that is other equity. And here again, we'll take the tabs. Oh, financial, oh my God, why is it not giving a trouble? My system seems to be very scared at the moment. Is it your feelings getting reflected? By the way, let's, I think, take a little interim inputs from your side as well. What is your comfort zone on the consolidation process? Now, we've come a long way from, simple consolidations to complex adjustments like chain holdings and all. What is your comfort zone on a scale of 10 on this area? I think it's all about, remembering what is to be done at each step, but I think it should be at least around a 9 or maybe a 10. Very confident. That's superb. Now 10 by 10. Wonderful indeed. Okay, so we are now considering the tab number 2 and we are considering the tab number 3. This is the reserves. Here we'll take the capital reserve and we'll take the retained earnings as well. So let's consider the data holding company's own profits as well. I've seen internationally, if you look at questions, not to scare you, but if you look at the questions, especially when you look at the questions which come in IFRS diploma and all those things, they've got like a huge question comprising of, adjustments relating to financial instruments as well. And they give you a lot of rectifications of errors in that, in which you see that there are errors and all. So I feel sometimes, that trend we might see in the exams, you never know. Okay,
Sir,
so let's begin. Hanji beta.
Can you take one such example from the case that you just discussed?
It'll take me at least 1.5, 2 hours to do that question. Let's see if we get this, if we get enough time, because I need to cover up the concept of consolidated income statement as well. And then I need to give you some changes in ownership interest calculations as well. So if we get time, we'll definitely add one to it. Okay, so let's begin with the holding company's own balance sheet. Let's see what is the reserves. I think is 1150, and the retained earnings is, I think, 1030. Now let's consider the share in the post acquisition share. So we need the share of LX in MX, LX in MX, and we need the share of LX in NX, the top company in the bottom company post acquisition. So let's go to the analysis back and see the post share. This is 50 and 120. This is 30 and 80. So 50 and 120. So this is 120 and this is 50. And for this company, sorry, this is 120 and this is 50. And this company, I think, was 80 and 30, 80 and 30. So this is 80 and this is 30. Now let's see the percentages as well. So what is the percentage of the LX and MX? This was 85%, I think.
Yes.
And this is, I think, 51%, if I'm right.
Yes, sir.
Correct. So let's see the share in the post-acquisition earnings. Okay, I think somebody's telling me, sir, at least show the question. Let's see, if we get time, we'll perhaps do that. So 120 into 85%, that's 102. 40.8, 42.5, 15.3. So we can add all this up. This is, I think, 1172.8. 1207.8. Just see if the figures are correct, I hope. This is coming to 2380.6. Right, and I guess I'll make
The
a
capital
consolidation.
reserve.
Okay, sorry, missed the capital reserve. You're right. What was the capital reserve?
5.
512.
512.
So,
Let's, Hanji beta.
yes, nothing, sir.
Okay. So let's, I think, add this as well. 2380.6 plus 512. That's
2892.6.
2892.6. Great. Now let's make the consolidated balance sheet. I'll not make it too long. Let's keep it short. We'll just quickly manage the balance sheet as well. Step number 7, add up all the figures now. Consolidated balance sheet. Let's begin with the asset side. We've got the non-current assets. So we can add up the PPE. This time I'm not showing you the breakup. I'm just adding this up. It's 4,500. So this is 4,500 for the PPE. There is no goodwill. It was capital reserve. Investments will not appear in the balance sheet. Let's see the inventories. And I think there's no intercompany owings as well. And there is no stock reserve as well. So just add the inventory. 3140. Current assets inventories 3140. Then trade receivable 2305, that is trade receivable. Bill receivable 710. Bill receivable is 710, and cash equivalents 1085, 90, 150. That's 1325. This will give us the total of the balance sheet on the asset side.
11,980.
11,980. Then let's go on to the liability side as well. So equity and liabilities, we'll take the equity share capital as well as the other equity. Equity share capital is 3,400. And as far as other equity is concerned, this is 2892.6. We can take the NCI as well. So what was the NCI? 1217.4. Then next in the balance sheet, we are given trades payable. Okay, bills payable, there is an intercompany owing. I think we missed that. So bills payable 55 is to be eliminated. So bill receivable, let's eliminate that 55. 710 minus 55.
655.
655. Let's change the total of the balance sheet as well.
11,925.
11,925. Okay, then coming back on the balance sheet, we've given the trades payable 2920, 690, 805, 4415. That's 4415. That's trade payable. I guess that's it. C, is the balance sheet agreed? Is the balance sheet agreed on this?
Yes, sir.
Yes, sir, agreed.
Great. So the balance sheet is agreed at 11,925. That means we've done it perfectly correct. Wow. That was on the chain holding aspect. Superb. Okay, so this takes care of my consolidated balance sheet agenda, but it doesn't take care of the consolidation as a whole, because when you make the consolidated balance sheet, you also need to consider a consolidated income statement also into account. Okay, so I am now going to give you some inputs on the consolidated income statements now at this stage. I think that stock reserve which you requested is also taken care, I guess. We are done with the inputs there as well. Okay, so let me just now add some more inputs at this stage. Okay, somebody had some questions from the previous part. If you want to ask me at this stage, you can. Otherwise, I'm going to just start with the consolidated income statement at this stage. If it's a little smaller, you can ask me at this stage.
Hello, sir, can I ask it now?
Yeah, please.
So it was with regards to the discussion on para 4, para 4B, and para 34 that we had done. We were taking an example from the education material, the last example that we discussed, wherein we conclude first that there are two companies, A Limited and B Limited, wherein A Limited was doing something that was related to the holding company
Correct.
activity, where
Yeah.
was limited. Now, when I apply the three-step model, what I have understood that B Limited would be subject, since B Limited did not satisfy the three-step model, B Limited is not required to be consolidated, versus A Limited would be consolidated.
Okay, so you're confused with the inputs in terms of what we decided, and you decided differently, right?
Yes, because in the class we had decided that A Limited would be disclosed at SPPCL versus B Limited at would be consolidated. So it's confused on those lines.
I'll just remind you the facts of the case, and I'll just quickly run it through. The facts of the case was something like this. And we'll just run this model out here. So there was a company PQR on the top that was supposed to be a non-investment entity. That was the question, right?
Yes, sir, the last one that we did.
I think it was the last one only, where it had a company XYZ. Maybe if you remember the names, this is from the education material only.
Yes, from the education.
Yes, so they had 100% stake in this company. This was an investment entity. And then they had got a stake in terms of two different companies. This was a non-investment entity. And this was an investment entity. I think now you'll recall this was the question, right?
So your video is, I'm not receiving your video.
Oh, sorry. Okay, is this the same question, right? I think it was the same one which you were asking. And it said that the company is doing similar, it's got a similar business as XYZ.
Yes,
Is
sir.
this the question, right?
Yes, sir.
Okay. Now we'll just run it through. With your help, I'll run it through in terms of how we apply the three-step model. Now, number one, when I said on the three-step model, I said, number one, you need to see that is the parent company XYZ an investment entity. So what do you say, yes or no?
Yes, it's an investment.
So can I say if the answer is a yes, I'm going to go to the step number two. Any challenge on step one?
No, sir.
Okay. Now we'll run this for A and B separately. We need to run this for A and B separately. So now we say that is A Limited an investment entity? Yes or no?
No.
No. So if it is not an investment entity, then what do I do? Do I need to go to step three? Correct?
Yes, sir.
So I go to the step number three. When I go to the step number three, is A doing the same work as XYZ?
Yes.
So if it is yes, then you need to consolidate.
We need to consult. Yes.
Correct? That's what we decided, that in this case, consolidate financials will be done. Because it's like apples and apples. Even though it's not an investment entity, but the work is same, apples and apples. Consolidation would make sense. Exemption is only if both are investment entity. Now, if you see the other side, is B an investment entity? Yes. So do I need to go to step three, or can I directly conclude that consolidated financials exempted? No need to make, you're not going to make, right?
Yes, sir.
Right. Did you get the picture now? Yeah.
If I do not know if we require to go back to the class, but in the class, I think it was the conclusion that when you've given our the notes, in the notes it was said that A would be shown at SPPPL. So that's why I got confused. What you discussed is what I also derived from the three-step model.
Okay, maybe I don't remember, by mistake I would have said that. I don't know. I don't remember that. But the concept is that there are three cases, to put it clear. If the parent is investment, the subsidiary is investment, no consolidation. The parent is investment and the subsidiary is non-investment, the work is not related, no consolidation. Third is parent is investment, subsidiary is non-investment, and the work is related, consolidation.
Charles checking if my understanding is right outside. Thank you, sir.
Okay, you're welcome. Right. Okay, so far so good. I guess now we can go further. Any further questions you've got, or I can now go further?
That's it, sir. I'm clear, sir. Thank
Okay,
you so much.
great. You're welcome. Now, friends, I am going to give you a structure of how to make a consolidated income statement. It's very simple, but you just need to get some focus points clear. And I'm going to give you just a structure to begin with. We'll do practical illustrations on the consolidated income statement also after that. So first, let's get the structure clear. I'm now coming to the concept of a consolidated income statement. I'm looking at the concept of making a consolidated income statement. So I'll give you, first of all, a basic way of consolidating an income statement, and then I'm going to give you some focus points which we need to keep in mind when we make a consolidated income statement. Trust me, just like a balance sheet, you aggregate the assets and liability 100%, irrespective of the percentage. Even in terms of consolidated income statement, you need to consolidate income and expense 100%, irrespective of the percentage. So let's consider that when you consider the figure of revenue. Now let me do one thing. Let me just give you the focus point number one. I'll give you the focus point number one. So let's consider this is holding, and let's consider this is subsidiary, and let's consider this is adjustments, and let's consider this is total. Now hear me very carefully. Hear me very carefully. From the revenue, I'll also be considering the reduction of the cost of sale. Let me also organize this part as well. Rather, let me take some figures to illustrate the inputs. This is holding, this is subsidiary, this is adjustments, and this is the total. Now, when you are going to consolidate the income statement, the focus point number one is there could be some intercompany sale and purchase between the two companies. It could be downstream or it could be upstream in nature. Now, get one thing very clear. In terms of the consolidated income statement, when you are considering revenue or the cost of sale, it does not make any difference to me. It is upstream or downstream in nature. Yes, the impact of upstream, downstream will impact me later, but not at this stage. So when you are going to consider, let's say, let's take some figures. Let's say you took the revenue of the parent company, let's say it is 500 lakhs. And you took the revenue of the subsidiary company, let's say it is 200 lakhs. Now what I need to do, I need to basically eliminate the intercompany sale or purchase. I need to eliminate the intercompany sale or purchase at this stage. Now, two focus points. The elimination will happen irrespective the goods have already been sold to a third party or the goods are yet to be sold to the third party. It does not make a difference to me whether the goods are still unsold or the goods have already been sold to third party. Focus point number two. It doesn't make a difference to me whether it is upstream or downstream in nature. Whatever is the sale and purchase between the two companies, eliminate it. So let's say between each other, they made a sale of, let's say, 20 lakhs. So what is the focus point? That when you are eliminating this 20 lakh rupees, you need to keep two focus points very clear at the back of the mind. And what are the two focus points? The focus point is number one. It does not make a difference. There is no difference. There is no difference whether it is a downstream transaction, whether it is a downstream transaction or it is an upstream transaction. Do not get worried at this particular stage, because the idea is to reflect the sales and the cost of sales, which is to the outsider. In any case, when you're reducing the figure from here, you want the figure which is the sale to the outside world. You need the figure which is the cost of sale to the outside world. So don't get worried whether it is upstream or downstream in nature. Number two, At this particular stage, it makes no difference. Don't get worried on the fact that goods are sold or unsold. The goods are still unsold or not. It is still unsold or not. I will eliminate the entire profits. I will eliminate the entire profits in this case. I'll eliminate the entire sale in this particular case. It doesn't make a difference to me whether goods are unsold or not. So don't get emotional, it is down or upstream. Don't get emotional, it is still unsold or not. The idea is to throw out the sale purchase between each other. And accordingly, you take this 700 minus 20, that is 680 lakhs. Similarly, when you consider the cost of sales, let's take the figures. Let's say this is to the extent of 300 lakhs. And let's say this is to the extent of 80 lakhs. So what I will do, I will again reduce the intercompany sale or purchase, and I will reduce 20 lakhs. And this is the same figure. Get this clear. This is the same figure. You say, so what are you doing? You're eliminating a common figure from revenue and the cost of sale. So how does it make a difference on the profit? I know it doesn't make a difference to the profit. In this particular case, if you reduce 20 and 20 here, let me first make it very clear. When one company made a sale to the other company, the sale to one is the cost to the other. So the sales of one company is the cost to the other. So this figure will also be the same. The figure is going to be same, 100%. Now, you need to do one thing at this stage. Now you need to consider that if there is any goods which are still unsold, what I will do, I will add the stock reserve, which is relating to the unsold goods at this stage. I will add the stock reserve to the cost of sale. You heard me correct. I said I'm going to add the cost of sales to, I will add the stock reserve to the cost of sale. So the only thing what you need to keep in mind is from the revenue, eliminate the selling price. From the cost of sales, eliminate the selling price. And to the cost of sales, you will add a stock reserve. Let's say the profit on the unsold goods is to the extent of, let's assume 4 lakhs. Let's assume 4 lakhs. So now let's see what is the figure which we are getting. It is 300 plus 80, and this will be minus 16. It comes to 364 lakhs. Now you need to understand what is the implication of this. And the implication is, this is, if you look at the figure, this is a figure which is after reducing 20. And this is a figure which is after reducing, you can say, only 16. So which means that in this case, you eliminated 20, and in this case, you eliminated 16. So this is minus 20, minus 16. This is revenue minus the cost of sale, minus 20, minus becomes plus 16. So what is the net impact? It's minus 4. What is the net impact? It's minus 4. Are you getting my point? Are you getting the mathematics clear on this, right? I'll put it once again to you. Now, this is one major focus point where people tend to get confused in terms of consolidation. Remember one focus point. When you do the consolidation of the income statement, just like a balance sheet, you need to aggregate the assets and liability. And when you aggregate the assets and liability, same way you aggregate the income and expense, 100%, irrespective of the percentage. So what are you supposed to do when you consider the revenues and when you consider the cost of sale? First, get one thing very clear. You need to reduce from the revenue as well as from the cost of sale a common figure, which is the selling price of the goods sold to each other. If you're eliminating 20 lakhs from here, you're eliminating 20 lakhs from here. When you're eliminating this, don't get worried whether goods are unsold or not. When you're eliminating from here, don't get worried, it is upstream, downstream. The idea at this stage is to see what is the sales to the outside world. What is the cost of sales of the outside world? So there will be an elimination of a common figure from both revenue and cost of sales, irrespective up or down, irrespective goods are unsold or not. But then become conscious. By eliminating 20 from revenue and eliminating 20 from cost of sale, there is no impact on the profits. But you need to eliminate the unrealized earnings as well. If you need to eliminate the unrealized earnings, what I will do, I will add the stock reserve to the cost of sale. By adding the stock reserve, you're increasing the cost of sale. By increasing the cost of sale, you are decreasing the profits. Get the chain clear? By increasing the cost of sale, your profits will go down. So what you need to do when you are taking the cost of sales, upstream, downstream doesn't make a difference. You just need to see that whatever is the unrealized profits added back. So when you add that 4 lakh rupees, this is eliminating 20 and this is eliminating 16. So when you take revenue minus the cost of sale, it's like minus 20 from the revenue. It's like minus that is plus 16 in the cost. So minus 20 and plus 16 makes it net minus 4. The profits automatically will reduce by the amount of unrealized profits. Did you get my point? I hope I'm very clear on the agenda. Great. So this is my focus point number 1, that what you need to do in this case. Next, very important inputs at this stage. Now, the other important agenda is that when you consider the figures of the subsidiary, that's like focus point number 2. You need to be careful and watch out the date of acquisition. Is the date of acquisition at the beginning or prior to the beginning of the year, or is it somewhere in between the year? If it is in between the year, you need to consider only the post-acquisition figures of the subsidiary. So when you go to consider the revenues and the cost, you cannot consider 12 months figure. You need to consider only what is post in nature. So I would say you need to first of all watch out. That is the date of acquisition, beginning of current year or prior? Is it beginning of the current year or before that? Or is the date of acquisition within current year? Is it within current year? So you need to consider this very clear. This is something which you need to watch out at the beginning of the question. So you need to see that when you are doing a consolidation of the income statement, the date of acquisition is very important, because this date of acquisition will decide the fate. If your date of acquisition is beginning of the current year or before, I will be able to take the entire 12 months figure of the subsidiary. But if it is supposed to be within the current year, I will take only pro rata figures of the current year. I will take only the pro rata figures of the current year. This is focus point number 2. Rather, I would say this is the first focus as you start with the question. So I would say this is focus number 1. I would say this is focus point number 1. And I would say this intercompany sale and purchase, what you're doing, this intercompany sale purchase is supposed to be focus number 2. This is the focus number 2. So in a consolidated income statement, watch out for the date of acquisition, which decides, are we considering 12 months or are we considering a proportionate number of months? Focus number 2, intercompany sale purchase and stock reserves impact on the revenue and the cost of sale. Then there is another third focus point as well. Once you've done all these calculations, you will be able to get the profits. You will be able to get the profits of the, you can say, consolidated figure. Now, this profit is supposed to be divided. It is supposed to be divided, what we call it's attributable to the parent company. And this profit is to be divided or attributable to the NCI as well. So once you get the profits in the consolidated income statement, you are going to get the profits which is split between the parent and NCI. And when you need to split this profits between the parent and NCI, we will need a focus number 3. We'll need a focus number 3. I will not give the share to the NCI based on reported earnings, but I will give a share on the basis of rectified earnings. So what do you mean by that? That we'll see in the question. But the focus which you need to keep at this stage is that in this particular case, we will compute the share of NCI. We will compute the share of the NCI in the rectified profits of the subsidiary. We will calculate the share of the NCI in the rectified profits of the subsidiary and not the reported profits. Now, what is rectified profits? That we'll see later. But I will have to compute the rectified profits of the subsidiary company, and I will not consider the reported profits of the subsidiary company. Why is this so? How is it taken? That all we'll see later. So 3 focus points. In the consolidated income statement, watch out the date of acquisition. That will decide 12 months or less than 12 months. When you take the sales and the cost of sales, you need to eliminate the intercompany sale purchase, add the stock reserve. And when you calculate the profit split between the parent and the NCI, you need to consider in this case NCI share in rectified earnings. How do you look at the rectified earnings and all those things? That we'll see in a practical illustration. I have basically given you the focus in terms of 3 main agenda. How they are applied, we're going to see them in good detail in the next session with you, when I'm going to concentrate on the consolidated income statements. Right, friends, so I think that's all what we have for the day. So we're going to continue this chain in the next class with you. So if you've got any questions, you can ask me. Otherwise, we are done for the day.
Sir,
Hanji beta.
sir, if there's a non-adjusting event with regards to the subsidiary company, because the financial reports were finalized on a date, say on 30th June, but the financials were finalized on, say, September for the parent company. So will that non-adjusting become adjusting?
You mean to say the reporting dates of both the parent subsidiary are on different dates, right?
Yes, sir.
Okay, number 1, if the reporting dates of the parent subsidiary are falling on 2 different dates, number 1, you need to first make the balance sheet of the subsidiary in accordance with the parent's closing date. But if due to any reasons it is not possible, then you can even consolidate the 2 balance sheets on 2 different dates, but the gap should not be more than 3 months. Now, coming to the point, if let's say the parent is closing on 31st March of the year and the subsidiary is closing on 31st December of the previous year, you need to extend the subsidiary's balance sheet for another 3 months. And when you're going to extend this for another 3 months, then accordingly, whatever transactions have taken place in those 3 months span will be incorporated. Now, if you're looking at what will be the status of Index 10 with reference to the 3 months balance sheet, is that correct?
Sir. Yes, sir.
Okay, then this may not be asked in the exams. Actually, it would be a practical issue, but in the exams, it's difficult for you to ask because there is no clarification apparently given that what's going to be the Index 10 cutoff date for this particular purpose. So that's going to be a little practical challenge, but standard does not address this issue. So from the exam point of view, you will not confront that issue. But yes, they may give you data in order to make a balance sheet of the subsidiary on 31st March, 3 months later.
Okay, sir. Thank you, sir.
You're welcome. Right, friends, I think that seems to be all. So thank you very much. I'm going to see you in the next class. Thank you. Bye-bye. Take care. And please do your cumulative revision. Thank you.
Thanks, sir.
Thank you, beta.
Thank you.
Hanji, thank you.